Did you know that in the United States, there's a distinct difference between a real estate dealer and a real estate investor? Whether you're flipping houses, buying rental properties, or partnering on some kind of development project, everyone who invests in real estate falls into one of these two buckets. These are two separate tax classifications by the IRS, and whichever bucket you fall into, it can have a big impact on how much you end up paying in taxes for each real estate deal you do. So what exactly is the difference between a real estate investor and a real estate dealer? Well, a real estate investor is one who buys real estate with the intent of holding it as a long-term buy and hold investment. Some common examples of a real estate investor include an individual who buys a rental property, an entity that buys an apartment building and rents out the units to various tenants, a mobile home park owner who buys the land and/or mobile homes and leases them out to the residents of the park, a storage facility owner who rents out individual storage units, or any property that is purchased to generate an ongoing source of rental income. By contrast, a real estate dealer is one who regularly buys and sells real estate in the ordinary course of their trade or business. What does this mean exactly? Well, some common examples of real estate dealers would include house flippers who buy houses, fix them up, and sell them for a higher price to make a profit, real estate developers who buy land, build subdivisions, and resell the lots, real estate wholesalers who buy properties and resell them quickly without making any changes or improvements to the properties, land investors without any other sources of income who buy land at a low price and resell it quickly for a higher price with or without making any improvements or changes to the land. Or really any real estate transaction where the properties are treated like inventory that regularly cycle on and off the balance sheet. So why does all this matter? Because when you compare a real estate dealer to a real estate investor, a dealer is taxed like someone who is running a business that buys and sells inventory, whereas an investor is taxed like a passive investor who collects a regular income from their properties. Because a dealer is treating their properties like inventory, they are subject to all the normal taxes that other businesses have to pay, like self-employment tax and short-term capital gains, and this means a dealer will end up paying a lot more in taxes than an investor will. On top of that, if a dealer sells a property through an installment sale, they'll have to pay taxes on the entire proceeds from the sale immediately in the first year, not over time, as the payments are collected. Now, one thing to note here is there is one small exception for certain types of residential land sales, but for pretty much any other type of real estate installment sale, all those taxes have to be paid immediately in that first year. This is a huge deterrent for dealers who sell their properties with owner financing. On the other hand, an investor has a much more favorable tax position because when they sell their properties, they pay a lower long-term capital gains tax, they don't have to pay the self-employment tax that is applied to real estate dealers, and they can pay the taxes on their installment sale proceeds as the money comes in each year, not immediately in that first year as dealers have to. And let's not forget, real estate investors who own rental properties have the ability to write off depreciation, which is a huge tax advantage that real estate dealers don't have, because all of a dealer's properties, again, are treated like inventory, not long-term cash flow producing rental properties. So how is this distinction made exactly between a real estate dealer and a real estate investor? Well, real estate dealers are not specifically defined by the IRS, which means there are a number of different ways to measure this, and the definition is ultimately open for interpretation by the prevailing court. According to the IRS, the correct answer depends on a number of factors. Factors like the reason why the property was acquired in the first place, the original intent of the buyer, what kinds of improvements, if any, were made to the property and to what extent they were made, the frequency and number of sales the investor has made, the amount of income generated by the property compared to the individual's other sources of income, the nature of the taxpayer's business, the extent of advertising that was done to promote sales of each property, whether the property was sold directly or through brokers, and how long the property was held before being resold. Now, these are just some of the ways a taxpayer or their accountant can make this judgment call, but again, ultimately, the IRS can and will have the final say on whether you're a real estate investor or a dealer. If they disagree on your assessment, they have the authority to override your determination. If you're in the business of buying and selling real estate and you do it in large quantities in a given year, chances are you're going to be classified as a dealer. But this doesn't mean the tax situation is all bad for real estate dealers. Dealers do have one tax advantage. Their gains are considered ordinary, which means they can use any losses to offset their gains. Since the classification of a dealer versus an investor can have big implications for the taxes a person has to pay, you can probably imagine most people will do everything they can to fall into the investor bucket and avoid being classified as a dealer. So what are some solutions to this problem? Well, interestingly, the classification oftentimes has more to do with the person's intent than what actually ends up happening with each property. For example, there can be someone who buys a rental property with the intent of holding it long term, but they end up selling it sooner for unforeseen reasons. And depending on the nature of the situation and the outcome of the different measurements described earlier, they may still be considered an investor because of their original intent. Likewise, there could be a developer who has technically held onto their properties for many years, much longer than anticipated, but again, since their original intent was to sell their properties quickly, they would still be considered a dealer in most cases, even though the property is unintentionally turned into a longer-term investment. And it's also important to note that it is possible for one taxpayer to be both an investor and a dealer at the same time. Under the IRS code, each property is looked at on a standalone basis. In other words, a real estate investor can have a portfolio of rental properties where they are considered an investor while still being considered a dealer with regard to a different single property they bought and subsequently flipped. So that investor or dealer label doesn't necessarily have to apply to everything they own depending on what their intent is for each individual property. And obviously keep in mind, nothing we're covering here in this video should be considered tax or financial advice. Please be sure to talk to your CPA or financial advisor to get more specifics about your situation. If you want to learn more about the differences between a real estate dealer and a real estate investor, be sure to check out the full article on retipster.com, which you can find linked beneath this video. And if you want to expand your real estate knowledge, be sure to check out this next video, and we'll see you there.